Have you ever felt that unsettling quiet before a storm? That's what's happening right now just beneath the surface of the world's financial system. In the next few minutes, you are going to understand exactly why the BRICS nations and China might be pulling the rug out from under the US dollar, and more importantly, what it means for you, whether you're in New York, Berlin, or Vilnius. By the end of this video, you'll have a clear mental model of what's changing, what you can do, and where to focus your attention. First, imagine your financial safety net, the one you've always trusted, is quietly starting to fray. For decades, we've been told the dollar was the immovable pillar of global finance. It was the safe harbor in stormy markets, the go-to currency for trade, investment, and national reserves. We all took it for granted. But now that solid ground is shifting. Lean in, because you can't see the gears turning, but you will feel the tremors. Picture a giant clockwork mechanism running the global economy. The dollar has always been the main gear, spinning smoothly, driving everything else. But now, other smaller gears are aligning and starting to push back. For instance, China, which holds over $1 trillion in US assets, is gradually reducing its holdings. They're building alternative payment systems and reshaping how international trade is settled. You might not hear the individual clicks of these gears, but you'll definitely notice when things stop meshing smoothly. Why does this matter to you? Because when the dollar's dominance loosens, it changes the cost of everything. The price of the goods you buy, the interest on your debts, the cost of doing business abroad, it all gets affected. The very pipes that carry money around the world are being rerouted. For ordinary people, this means real, tangible shifts. Higher prices for imported products, weaker returns on savings, and a less predictable global economy. So, we have to ask, if this gear shift continues unopposed, what breaks first? This is where the old advice, just hold dollars, buy US bonds, and you'll be safe, starts to fail. The winners and losers of this new era are already emerging. In the past, the dollar was king. You held it, you traded in it, and governments borrowed in it. This gave the US a massive advantage, cheap borrowing, global influence. But the flip side is now becoming visible, dependency and vulnerability for everyone else. The losers? Anyone who blindly assumes that dollar equals safety forever. The winners? Those who start adapting now. They are the ones who diversify, who monitor the shifts in payment systems, and who aren't locked into a single currency or a single-minded view of the world. But that's not the whole story. You can't control global finance on your own, but you can position yourself so you're not a casualty of this shift. Let's talk about 3 practical moves you can make. First is a mindset shift. Realize that protecting your wealth isn't just about avoiding losses. It's about staying flexible. Think of your assets like water, finding the cracks and new paths, not like a rigid stone that shatters under pressure. Expect the unexpected. Second, embrace diversification. Don't just hold dollars. Think in layers. Your domestic currency, a major foreign currency, and alternative stores of value. Not as a gamble, but as a prudent hedge. If one gear in the system slows down, another can take over for you. Third, become a signal filter. Set up alerts for global currency flows, changes in central bank reserves, and major shifts in trade settlement systems. These are the flashing warning lights before the big movement happens. If a major player like China significantly reduces its dollar holdings, you want to be one of the first to know. These strategies work because when the gears of the global economy start to misalign, the relative value of every asset changes. If you just hold dollars and assume nothing will change, you risk being left behind in the new alignment. Let's look at a real-world example. Back in 2015-16, a savvy investor in Europe noticed the growing imbalance between the euro and the dollar. While others clung to dollars, he quietly shifted part of his portfolio into non-dollar assets, bonds denominated in other currencies, physical assets, and reserves in different currencies. When a trade war rattled the markets, his dollar-heavy peers saw their import costs spike, while his diversified portfolio cushioned the blow. He didn't get rich overnight, he just didn't get caught in the crossfire. Now, let's move from defense to offense, because major shifts like this don't just create threats, they open doors. Think about creating small asymmetric opportunities. These aren't wild speculations, but smart options you can activate later. For example, gaining some exposure to a major non-dollar trade corridor, like the one between China and Africa, or India and the Middle East, where trade is moving away from the dollar. If that corridor scales up, you benefit. If it doesn't, your exposure is small. Let's translate this into a simple model. Currency plus trade rail plus store of value. Pick one currency you trust outside the dollar, one emerging settlement system to monitor, and one asset class that holds its value if the dollar weakens. In practice, this could mean holding some yuan-denominated assets, following the development of new cross-border payment systems, and having a hedge in an asset like gold that isn't tied to the dollar. You're not betting on a dollar collapse tomorrow. You're positioning yourself to ride the wave if the shift accelerates. Here's another case. A small tech firm in Lithuania decided to start invoicing some of its services in Chinese renminbi, noticing their partners were pushing for it. At first, it was awkward. They had to manage exchange risk and unfamiliar contracts. But when China quietly shifted its reserve policy, that firm was already one step ahead. The turning point came when they accepted a payment through a cross-border system that bypassed SWIFT. They didn't make millions overnight, but their currency risk dropped and their future costs were automatically hedged. This brings us to the most important part: how to watch the gears and act. Not all signals matter. Most are just noise. Here are the few you should actually monitor. First, reserve flows. If major central banks significantly reduce their dollar holdings and increase local currency reserves, that's a systemic signal. Second, settlement systems. When countries launch viable alternatives to SWIFT or digital currency rails that bypass dollar clearance, that's a structural shift. Third, trade invoicing. When major commodities or regional trade corridors start being priced in non-dollar currencies, that slowly erodes the dollar's dominance. And finally, policy and sanctions. When the dollar is used as a weapon, watch how countries react by accelerating de-dollarization. Here's what you do based on these signals. If reserve flows shift more than 15% away from the dollar in a year, prioritize hedging your dollar exposure. If new non-dollar settlement networks launch in major trade zones, consider getting exposure to those currency pairs. If trade invoicing shifts widely, it's time to revisit your portfolio's currency mix. So, where does this leave you? You came in perhaps feeling uncertain about global finance. Now, you leave with clarity. The dollar's throne hasn't toppled, but the gears beneath it are turning. You know why it's happening, how to protect yourself, how to find opportunities, and what signals to watch. For anyone living in Europe or working globally, this is critical. It affects your cost of living, your investment returns, and your future options. Here's your map. Protect. Adopt a flexible currency mindset. Diversify and monitor the key signals. Grow. Create small, optional exposures aligned with emerging payment systems. Read the signals. Watch reserve flows, payment rails, and trade invoices like a hawk. You're not waiting for a collapse. You're preparing for a turning point. If the dollar remains dominant, you're still safe. If the shift accelerates, you'll be ahead of the curve. In our next deep dive, we'll examine which regional trade corridors are most likely to ditch the dollar first, and what that means for your investments. Thanks for watching. If you found this valuable, please like, subscribe, and hit the notification bell so you don't miss it.